Hey guys, this is Mike from Your Car Dealer Bond, and welcoming you guys again to listen to more nuggets for all things that have to do with used car dealers. Here we go. What I wanted to mention is this really big thing, which is you guys all buy insurance. Well, I wouldn't say all. You guys that are buying insurance, that have insurance, kind of understand risk in a whole different way that you guys don't buy insurance have no clue about. You guys have no clue about it. And why don't you have a clue about it? Because nobody sat you down and asked you a series of questions that ends up to be about 10 pages full and is really sitting there gnawing your ear off. To get your bond, it's a pretty simple process. You're filling out a page of questions that range from, with your address and your business name. The toughest thing on there is your social, but not even that's something you don't know or got to go look up or got to sit there and think about. Where insurance, dealer insurance, to properly insure your risk, you got to know things like, as the agent, you would need to know things like how many cars at a time do you normally carry? Do you normally carry 2-3 cars in your inventory? Let's say the answer is yes. Okay, now let's think about this in this way. Is there ever a chance, and I do mean ever a chance, where you end up with more than that? Do you end up with 3 or 4 cars? There's a stunning, and I mean sizzling deal to this week at Manheim. You saw something you just couldn't pass up. Is that what you came across this week at Odessa? If that's you, and you could end up with 4 cars instead of your normal 2 to 3, what does that look like? Right? So we would build that profile of exactly what it would look. Now, again, what's your average vehicle? You'd be looking at average vehicle value. That's purchase price. We're talking purchase price, right? So you got a purchase price. Then you're going to think about recon. What's the maximum you're going to spend to recondition these things, right? And then you got to build in a little fluctuation because, again, your average could be that you spend $600, and that's your policy is you don't want to spend more than $600. But if this one ended up costing you $800 or $900, are you properly insured for that to happen at 3 different vehicles at the same time? And if you're buying each one of them for $250 more than you normally would, again, it's not that much fluctuation, but this might start off one way, and 6 months later, you got a totally different model, or 9 months later. Then that's not even to talk about your employees, who's touching these cars, what kind of coverages you need. I mean, there's really an A to Z here that they're going to go through and really ask you tit for tat what you need, what you want, how you want to insure yourself. Do you want to go for worst possible scenario, or you just want to get by the seat of your pants, or you want something more towards the middle? And really, there's so many different scenarios, there's so many different packages, the contract, explaining some of those coverages and the way that those sublimits, deductibles are being written, aggregate, type of all of that stuff. All of that goes into a contract where if you've never really been sat down and asked these questions, you're really not going to be, you're not going to understand your risk in the same way that somebody else might if they've been through this process. Now imagining you've not only gone through the process, but now you need to figure out how to lower your exposures. This is the segment we're going to talk about here, is kind of lowering those exposures and thinking about your overall exposure in a different way. One thing that you're going to want to really understand is you're going to want to understand your deck page. That's your the page with all your coverages, right? You're going to want to understand what kind of coverages you want and what kind of coverages you have. And then I think a step further is knowing not only what kind of coverages you have, what kind of deductibles you have. And I'm getting lowering your exposure. This is really the name of the game here, is how are we going to reduce the exposure? And I'm talking about your insurable exposures. And there's certain things that you're not going to be able to, depending on where you're at, there's certain things that may be more costly to insure, like let's say earthquake coverage or flood and